Hi everyone, welcome. I just wanted to talk about Chapter 2 a little bit. First of all, debits and credits. All debit and credit means is left side of the account, right side of the account. Maybe I'll move over here, it might be easier for you to see. But that's simply what it means. And this really confuses people. It does not mean more, less, better, worse. It just means debit, left side of the account, credit, right side of the account. Double entry. Each transaction is going to affect at least 2 accounts. Could affect more, but it's going to affect at least 2 accounts. That's what double entry means. So for every debit, there is a credit. Normal balance, or at least I should say for every debit, there is at least 1 credit and vice versa. Normal balance. Your normal debit balances, and what that means is those accounts that are increased by a debit are your expense accounts, your asset accounts, and your owner's drawals accounts. Now I put it on the board like this. You know, sometimes if this helps you at all, to think of it as the word debits, you increase specific accounts of expenses, assets, and and owner's drawals with the debit. I don't know if that helps you or not. There's all different acronyms. I've heard it, I've seen it as AID, ADE, all different things. So whatever helps you. But if this helps you, great. If not, find your own acronym. But it's easiest to remember what's increasing with the debit. And then you'll know any other account I'm dealing with, if it's not an asset account, if it's not an expense account, if it's not an owner's drawal account, then it must increase with a credit. So that's a real easy way to remember. Just remember what increases with a debit. So again, what this means is it's a normal balance. So normally, since we're increasing our expenses, assets, and owner's drawals, since we're normally increasing those with a debit, their normal balance should be a debit balance. And vice versa, any accounts that normally we increase with a credit, then their normal balance should be a credit balance. One other thing I want to mention, and then we'll stop for a moment, but the recording process. This is really important. What you're doing in the recording process is, first of all, you're analyzing transactions to see how they are going to affect the accounts. Then you're going to go ahead and enter those transactions in the journal. And now what you do is you transfer from the journal to the ledger. So that's the recording process. If you haven't done so already, please, before you go any further with watching this tape, please, if you've noticed up there, there's a study guide and a practice problem. Make sure you have a copy of both of those so that we can go on with this portion of the explanation. Hi. Okay, the ledger. What the ledger is it's our entire group of accounts. So it's all of our accounts. And the ledger is arranged in the sequence that they're going to be presented. These accounts are going to be presented in the financial statements. So we present the balance sheet first. So our assets, liabilities, owner's capital is first, and generally you'll have assets in the 100 range, liabilities 200, owner's capital 300. Then following that we have our revenues and expenses, and our revenues would maybe be 400s and expenses could be 600 to 700 higher also. We might have cost of goods sold as 500, you know, they vary slightly. But generally, this is the way they're presented. When we have our list of accounts, what we do is we always leave room in between. So there'd be room between cash and accounts receivable and supplies. There'd always be room because we might add an account later, and perhaps that's more liquid and that should show first. So we're going to always leave room within these numbers. You're never going to see them one right after the number. And I want to go through posting from the journal to the ledger. We'll go over one transaction that's going to be in our practice, just so that you can be familiar with it. Okay, for the general, I just wanted to give you an idea of how the general journal and the general ledger are going to look and how we are going to actually post from the general journal to the general ledger. So if you look at the practice problem I gave you, we're going to just look at the first transaction, which is Bob begins a computer service business with a cash investment of $20,000. So, if you notice on the general journal, we've got the date. I already put down the entry. We have cash, and that was debited for $20,000, and we have Bob Capital, that was credited for $20,000. And the explanation is an owner's investment of cash in the business. If you look at the top of that general journal, it says General Journal J1. That means this is the first page in the general journal. And the way the general journal is kept is it's just kept in chronological order. So as transactions are occurring, they're just all being written right in that general journal. Okay? So now we're going to take the information from the general journal and we're going to put it in the actual general ledger. So we're going to post it. So first of all, my reference is the page that this information appears on in the general journal. My reference is J1. If you notice this general ledger, this is just one account. It's a cash account. And if you notice, it has a number. Its number is 101. So anything going on with cash in the general journal will eventually find its way to this general ledger, the cash ledger. Okay, so we're not going to write an explanation again. We already did that in the general journal. We don't have to do it again. But we do need to know the amount that was debited or credited. Well, we debited $20,000. Remember, cash is an asset account. It increases with a debit. So we're debiting $20,000. Our balance is $20,000. So I'm going to stop here and I'm going to show you what the general would look like for the capital account, just so you can see both sides of it.